And I think the market is saying, we've got all the growth we need for right now. Now you pile in monetary policy going easier, cutting rates. And I think the market is saying, no, too much. All these rate cuts are going to do is raise the potential for inflation expectation. Now, in a lot of measures we've seen, there has been an increase in inflation expectations. The 10-year Treasury inflation protected security or TIPS break-even inflation expectations is at a 15-month high, or at least it was earlier this week. So this is, some of the things that we've been seeing that says that the market is kind of trying to communicate to the Fed, you've been doing too much, and we don't need all of these rate cuts. And they keep talking about more and more rate cuts. Waller's been talking about it. Goolsby's been talking about it. Barkin's been talking about it. And on top of that, I think the market is going to just start to consider that if there is more rate cuts in the future, that it's just going to add to the inflationary expectations and not necessarily be stimulative for the economy.
On this episode of the What the Finance podcast, I have the pleasure of welcoming back the one and only Jim Bianco. So Jim is the President and Macro Strategist at Bianco Research. So Jim, thanks so much for coming on the podcast today.
Thanks for having me. Look forward to the conversation.
Yeah, very much looking forward to the conversation. I think the last month's been pretty crazy. I feel like how I've felt. And it seems like all markets have just been extremely volatile, up a lot one day, down a lot the other day, bonds, stocks, basically everything seems to be moving a lot. So yeah, why do you think this is happening? Is this Trump or is it something else?
I think there's a combination of a lot of things going on. I think at one level, there is a tendency for markets to kind of turn towards the beginning of a year because there's a big institutional bias in markets. Managers get paid a performance bonus based on their year. And that's why they tend to kind of get a little bit quiet towards the end of the year, although this year might have been a bit of an exception to it. And then the aggressive bets come down in January. So that always heightens volatility. We've got a new administration coming in. That's always going to heighten volatility. And we've got a contentious argument about Fed policy. The Federal Reserve has been cutting interest rates. Bond yields have been rising in the face of that cutting of interest rates. And the contentiousness is, what is the cause behind that? I'm of the opinion that it's the market saying to the Fed that you've got the wrong policy. Others have argued, no, it's about, the deficit being large and about stimulus coming and potentially tariffs coming as well. And I would argue that two out of the three of those things, other than tariffs, were going to happen regardless who won the election. So the market shouldn't have just all of a sudden had an epiphany about the deficit because it's always been there. But I think the change on the margin has been Fed policy. So you add all of that up, between Fed policy, changing administration, and it's a new year. And yeah, it's not surprising that you're seeing higher volatility in the markets in January. That doesn't mean we know which direction it's going to go, but it's kind of something that you would expect.
Yeah, really interesting. So you think the Fed made a mistake, a few months ago in cutting, and I guess they've cut a few times since.
Yeah, I think, the way I look at it, first of all, if you look at a chart of interest rates, the 10-year yield in the US or 30-year mortgage rates, they were going straight down and they bottomed literally 2 days before the Fed meeting in September when they cut 50 basis points to start. And they've been going straight up since. So the turn was right around the Fed meeting within 48 hours. And that 50 basis point move was a bit of a surprise by the marketplace. There was some talk that it would happen, but the aggressiveness of the move, and I think rates have been going up. Why? Do I think it's a mistake? Because if you look at GDP forecasts, and if you look at the economy, it's growing at its potential. Potential is a number you can't, observe. It's a guesstimate as to what is the growth of the economy if it's not speeding up or if no one's stimulating it or trying to restrain it. That's its potential. Well, it's been growing there anyway. Then you throw in the idea that Trump is coming and he might be very stimulative, and that he might, extend tax cuts, deregulation, and tariffs. And I think the market is saying, we've got all the growth we need for right now. Now you pile in monetary policy going easier, cutting rates. And I think the market is saying, no, too much. all these rate cuts are going to do is raise the potential for inflation expectation. Now, in a lot of measures we've seen, there has been an increase in inflation expectations. The 10-year Treasury inflation protected security, or TIPS, break-even inflation expectations is at a 15-month high, or at least it was earlier this week. So this is, some of the things that we've been seeing that says that the market is kind of trying to communicate to the Fed, you've been doing too much, and we don't need all of these rate cuts. And they keep talking about more and more rate cuts. Waller's been talking about it. Goolsby's been talking about it. Barkin's been talking about it. And on top of that, I think the market is going to just start to consider that if there is more rate cuts in the future, that it's just going to add to the inflationary expectations and not necessarily be stimulative for the economy.
Yeah, and I guess that's a challenge with their dual mandate. They sort of, I think it sounds like they were sort of expecting some weak unemployment data to come through. It hasn't really come through. It's been the opposite. It looks like lots of companies were holding out, but until the election sort of results came through, and then now it sort of bounced back to life. So do you think that was the issue, that they were just looking at multiple different things?
Right. I would argue that that's exactly it. That in July, if we go back to July, the unemployment rate in the U.S. hit 4.3%. And it triggered the so-called Sahm rule, which was invented by Claudia Sahm, a former economist at the Federal Reserve of New York, that basically says that if the 3-month average of the unemployment rate rises more than 0.5% above its low of the last year, that every time that's happened, we've gone into recession. Now, in fairness to Claudia, she said when it did hit, it might not work this time for a number of reasons. And then in August, we had the QEW, the Quarterly Economic Survey of Workers. That's where they look at tax receipts and how many people are paying in taxes on unemployment insurance and the like. And they revised down the number of jobs that the economy had created by 800,000. I think the Fed got spooked by both of these numbers. And they're sitting there looking at themselves going, we've got a 5.25 to 5.5 funds rate. And if this revision down in jobs is correct, we all don't think the Sahm rule is going to trigger a recession. But what if it's right? And we're sitting here with this big fat funds rate, we're going to get blamed. It's going to be our fault. So quick, cut 50 in September and follow up with it so that we could start looking like we've been trying to deal with a potential slowdown in the labor market. The only problem was there was never a slowdown in the labor market. That as soon as after those two data points came about and suggested that there maybe might be a slowdown in the labor market, there was no more follow through to it. And the labor market kind of rebounded, and the unemployment rate has fallen now. And it doesn't look like the initial reasons about labor weakness for the Fed rate cuts ever came to pass. But yet they still kept cutting rates all the way through to December. And that's why I think that the market has been looking at it and not necessarily been thinking it's a good idea.
Yeah, it makes sense. And do you think they're sort of going to start, put the rate cuts on hold now? They're going to say, okay, data's coming back strong, or what are your thoughts?
If you look at the December dot plot, that's where all the estimates come in for all of the Fed officials. The 2024 dot plot. Now, normally we would never look at the 2024 estimate for December, but what it showed was 4 of the members of the Federal Reserve had an unchanged dot for that meeting because it was the last meeting of the year. But yet they cut rates 25 basis points. So that means that they had at least 4 dissenters because they were putting down dots that we shouldn't even cut at this December meeting. And we had one outright, dissenter, Beth Hammack, who was the newly installed president of the Cleveland Fed. She dissented, but there was 3 others in that meeting as well too. And Powell did say it was a close call in the press conference. So I think that whether or not the Fed is going to continue to cut rates into the future, there's been a lot of talk by a lot of people that if certain things happen, we'll continue to cut. That's their bias. That's what they want to do. But beyond that, I do think that there is a contentiousness within the Fed about what should the policy be. The thing that happens, and I'm as guilty of it as anybody else, Jay Powell holds his press conference, and he tries to basically tell you what the committee was thinking. And his statements are somewhat inconsistent at times. And I get on his case like others to say, man, you're giving us inconsistent statements. But then I got to remember, maybe it's because his committee is inconsistent. His committee is not in agreement as to what they should do. There's some that think one way, some that think another way. But like I said, right now, I think what they would like to do is have reasons to continue to cut rates. Whether they get them is a whole nother issue right now.
Yeah, because I think if you look at anywhere else in the world, any other central banks, they're sort of desperate to cut. We could cut the UK, Europe, other parts, but then the US staying steady, that's just going to absolutely, the dollar's going to rocket higher. So do you think that they look internationally, or is that not a thing?
No, I think they do look internationally, and I think that they have looked internationally at, this idea about synchronized growth and slowdowns and recoveries. But I think what they've come to the conclusion of is that that's not what's been happening lately. That the economy in the US is very different than what's been happening in Europe. The European economy is much slower than the US economy, highlighted by Germany, is in a very difficult spot right now with their economy. On the other side of the world, Japan is raising rates. They just hinted the day before we're recording this that they're going to probably raise rates at their July 24th meeting. And right over the Sea of Japan in China, they've got all-time low in interest rates, and their economy's in a desperate spot. So I think the Fed does look internationally, and what they're finding is it's a mess here, it's weak here, it's strong here, they're raising here, they're cutting here. So there's no consistency from what they have to see around the rest of the world. So this concept of synchronized central bank policy or synchronized global growth is not at play right now. Makes their job a little bit harder, and it turns at cross purposes. If the Fed is going to slow down and maybe hold rates, that influences the rest of the world. The ECB would like to see their interest rates get cut even faster than they are now, but they have to be careful about their currency, because if they start cutting aggressively when the Fed is holding, they're just going to wind up weakening the euro and maybe not necessarily make things better like they would hope a rate cut would do.
Yeah, it is really turning into the dollar wrecking ball, and I'm sure China is desperate for the Fed to keep cutting so they can announce their massive fiscal plan they want to announce. But yeah, with the yuan at such low levels, they really can't do that.
Yeah, not only that, but they've got all kind of problems right now. Their problems basically stem from their property markets. Let's back up. We all have seen the images over the many years of all of these ghost cities that they've built. These cities that are like for the population of 1 million people, and these gigantic condominium projects that they've built, dozens and dozens of them in these cities, and no one lives there. Well, somebody bought those condos, and the somebody that bought those condos is not the American public, excuse me, but the Chinese public. They bought those condos as an investment or maybe a future place to live. And now that they've got this massive oversupply and imbalance in the real estate market, they should be correcting it. Well, they got two problems. One, you're going to be telling tens of millions of Chinese, that investment you made, and it was government approved, at least in Europe and at least in the United States and private capital markets. We might invest in technology stocks, or we might buy real estate projects, and they might go bad. But it wasn't the government that was telling us to buy those things. It was our own decisions based on private inputs. But in China, it's the government. So if they want to start writing off that property, they're going to have to tell tens of millions of people, we, the government, told you to buy this. We, the government, are now going to make your investment worthless. That's not going to go over very well. Not to mention all of the loans that they've taken out, the mortgages that they've taken out on all of this property that is held by a lot of their banks. So they've got a real property problem. We in the US had a property problem in 2007 and 2008. It was extraordinarily painful to write down all of those assets and to restructure our banking system. We had the great financial crisis. The stock market fell 50%, and it left, you could argue, permanent scar on, the Western capitalist economies as we went into the post financial crisis recovery in 2009 and 2010. China probably needs to do something like that, but they're not. They're not, and it's really suffering. So their stock market keeps falling, their economy keeps getting weaker. They've announced back in September, it was like a stimulus program a day they were announcing to try and do anything to get their economy to go. And it got foreign investors, it got American hedge fund managers all excited to run in and buy Chinese stocks. And it lasted for about a week. And then their stock market peaked, and now it's been declining again into January. So they're in a big problem, but it really starts with the problems in their property market. No one knows what the value of their banks are if they're sitting on all these bad loans. They need to realize them. They need to write down the value of a lot of those ghost cities. But the problem, like I said, is that means tens of millions of people are going to get wiped out because that's their main savings vehicle. They bought one of those condos in those cities. Well, if they're going to bail out those people, that's going to be trillions of dollars. And so there's no good solution for the Chinese government right now. And that's being reflected in that their 10-year yield is plunged to an all-time low. Their economy, their economy is growing under 5%. Now, Western standards, that sounds like a lot. But keep in mind that in the last 50 years, there's only been 2 periods where the Chinese economy has grown less than 5%, COVID and Tiananmen Square. So under 5% growth is a red flag that the Chinese economy is really struggling.
Yeah, and I imagine do you see it sort of going Japanification of China, where it's going to be this slow balance sheet recession for decades? Or do they have to take action?
Isn't it perfect? The Japanification of China, right at the moment that Japanification of Japan might be ending. So we could send that term now, to somebody else. Because what's happening in Japan is for the first time in 30 years, their inflation rate has kind of gotten off of zero and seems to be settling out at around 2%. Doesn't sound like much from Western standards, but like I said, if you've been stuck at zero or negative inflation for pretty much 30 years and zero or negative interest rates, pretty much for 30 years, to get it to 2 and hold 2 is somewhat of a victory. And that's why you're seeing the Bank of Japan talking about raising rates. Well, finally, we've got nominal growth. We've got some inflation. We got 2% inflation. We don't need to have our official policy rate under or less than zero negative. We need to start to get it up. And so they've raised rates in March of last year. They raised rates in July of last year. And they've already signaled that they're going to raise rates at the end of this month. And they're trying to get to that level under the idea that wage growth is starting to move forward in Japan for the first time in a generation. Inflation is back. And hopefully with that nominal growth, because that's higher prices, not stagnating prices, that their GDP will start moving. That's been a little bit weak. And in anticipation of that, their stock market has been going up. And the Nikkei finally, in 2024, made a new all-time high. The last one was 1989. It took them 35 years to recover from their 1989 peak. So their market has started to recover as well. So this whole idea of this stagnation of Japanification of a market, not Japan anymore. It's now maybe very close to becoming a Chinification of markets.
Yeah, that's what we'll be saying in decades time. Maybe
Yeah.
we'll have to see. But then I guess, they obviously have an extremely high debt to GDP ratio. Is that a risk if they increase rates, or is that sort of the wrong way to look at it?
Yes, it is a big risk. Their debt to GDP ratio is about 250%. So they've borrowed 2.5 times the amount of debt that their economy has been producing, where the US is about 115 to 120. So they're twice of what the US has. There is a concern because we talk about it in the US, right? Look at our debt, look at our interest expense. It's more than the military budget. We can't see interest rates go up that much because it would really impact the federal government's finances because so much of it would get chewed up by interest expense. That's in the US. You can double that for China. Well, the problem that the Chinese have is that they have no choice. If you are a 2% inflation world and say a 1 or 2% real growth world, the two, inflation and real growth, are nominal growth. If that's around 3-ish% in Japan, then your interest rates need to somewhat approximate nominal growth, somewhere around 3%. Well, their 10-year yield is at about 125, and their policy rate is around 0.5%. If they decide, no, well, we can't have rates go that high because of our debt to GDP and our interest costs, we'll leave them down here at 1. You run the risk of overstimulating your economy and producing more inflation, and then you would just have it worse. Well, we'll leave interest rates down here and we'll let the economy get overstimulated. Bond investors will riot, and then bond yields will way overshoot on the upside and make it far worse. So they've got no choice but to raise rates. I think what they've done in Japan, Ueda has done in Japan, kind of like what Paul has said, is they kind of default to this concept of fiscal dominance. And what fiscal dominance means is we want to raise rates because we think it's the right thing to do. You're going to tell me that that's going to cause us interest expense, and with all our debt that it would impair our economy. We agree with you, but it's not our problem, the central bank. We're going to raise rates. You could go to the Japanese Diet. You could go to the prime minister. And you could tell them they have to fix that problem. We can't accommodate that problem. I think that's the right approach. Because if you accommodate too much debt, the world has plenty of examples of central banks accommodating profligate governments that borrow too much. It always ends badly. And so don't go into that mode. Don't accommodate it, and tell the elected officials, this is why you got elected. This is why you ran to be a representative, is to deal with these problems. So start dealing with them.
Yeah, great point. But I guess it probably has to get to the point of what, if it gets too bad, then monetary and fiscal has to come together to sort it out, or you don't think that should happen?
No, yeah, if it gets too bad, then they will, because they'll converge, right? The economy would then struggle, and then the appropriate thing would be to cut rates on monetary policy, and they would converge. But right now, they're not converging, and you can't, say, well, if we raise rates, it'll end badly at some point. Like I said, if you don't raise rates, you run the risk of it ending badly. You have to keep your interest rates at some modicum of where you think, the neutral rate is. And right now, Japan's too stimulative. They're below their neutral rate. They have to kind of start to creep in that direction. Otherwise, they wind up creating a whole nother set of problems. Instead of a weak economy, you create too much inflation. The one thing we learned about inflation from the American election, inflation impacts 100% of a population. Elon Musk feels it. People on public assistance feel it. It hurts everybody. It is a scourge of an economy. And to risk, well, we got to leave rates too low because we can't let, the interest costs go up, risks inflation, and that could be devastating. Look at what it did in our election. If you go and look at our election, the number one driver of our election was economic. And what was at the very high list of economic, it was inflation. And it matters, and it matters a lot that you keep inflation under control.
Yeah, and that's why we see most incumbents get sort of voted out, because global phenomenon, inflation, people don't like it, kicked out.
Yeah,
next person.
In 2024, something like 47% of the planet's population, the world's population, voted in an election for their national leaders. And that was the highest percentage of any year in history. And there's been data going back into the 19th century on this. It just so happens that all these elections aligned in 24. And if there was a common theme in every one of those elections, almost every single one of them, was that the incumbent party was either weakened. In the case of India, Modi survived, but he came out with a smaller majority than he went in, or the incumbent parties got kicked out. The United States being a good example, and the UK being a good example. And the UK is an interesting example because everybody says, well, it was a rightward shift. Well, it wasn't a rightward shift in the UK. It was a leftward shift to go back towards labor. It was almost as if 24 was the year where the public said, who's in charge? Okay, those guys are in charge. They're fired. Get them out of here. I don't even care what party they are. Just go away. We're going to try the other people. And that's what we've seen. And I think what's been a large driver of that mentality has been the global inflation post-COVID, because it's such a scourge on everybody that it's got everybody in this anti-incumbent mood.
Yeah, it'll be interesting to see if we sort of continue to see this in the future, or if everyone's sort of gotten to the point where they've not gotten over it, but things are back to normal and talking about the everything else that they normally talk about. But
Right.
if we go back to the US, that'd be so what do you think if the Fed sort of keep interest rates stable? I know currently, I think they, you'll obviously know this more, they sort of projected on the dot plots like 2 rate cuts this year, I think it was. What does that mean for yields? Do you see yields sort of coming down back to where they were before they started cutting, or do you have any thoughts?
Well, the big first thought, is you're right. The Fed is projecting 2 more rate cuts. The market is assuming that the earliest we will get one of those rate cuts would be May, maybe June, so that the January meeting, no cut, no move. The March meeting, no cut, no move. Maybe in the May meeting, we get a cut. But there's going to be a lot of data and a lot of things that are going to happen between now and then. If the economy continues to surprise in general to the upside, seems to be doing better than people think, I think the pressure is going to be on the Fed to not cut rates. But if they do try and continue to cut rates to some degree, I think it will be more of this continuation that we've seen in the financial markets, that they don't like that policy. And if you're not going to be serious about fighting inflation, let me back up. The thing that seems to be interesting about this cycle is if you go back to 2022, when the Fed started raising rates, most inflation expectations went down, and down a lot when they were raising rates. In 24, when they started cutting rates, inflation expectations went up. So what does that tell us? The market is concerned about inflation. When the Fed is raising rates, they're concerned too, and the market can relax and inflation expectations come down. The market is still concerned about inflation. And when the Fed starts cutting rates, it's concerned that we're going to get more of it and interest rates go up. So what do I think we're going to see in 25, a continuation of 24, right? Stronger growth, stickier inflation. I know the payroll, the December CPI report was a little weaker on the core side than was expected, but yet I still think that we're going to see, that's why I used the word stickier instead of high, stickier inflation as we go forward. And if we do see that sticky inflation and decent growth, I think that one of the things you'll see is interest rates in the US, let's call it yields on the long end, will continue to move higher. I don't think that, we hit a short-term interim peak at 480, 81 on the 10-year note yield. But ultimately, I think we're going to go back to that level. It might take a couple of weeks or a month or so, but we're going to go back to that level, if not higher. The highest yield we've had in the post-COVID period was October of 2023 at 5%. We were within 20 basis points of that earlier this week when we were hit 480, 481. I don't think that the 5% yield in October 23 was the peak yield for the cycle. We're going to go back and we're going to probably revisit that. So all of this is more about an idea of that the economy is going to be strong. Trump is going to be very stimulative, tax cuts, deregulation, potentially some tariffs. And all of that is going to lead to higher interest rates or higher yields on the back end of the curve, whether or not the Fed cuts rates or doesn't cut rates. Like we said, they've been cutting rates in September, and we've been getting higher yields throughout this period. So I think we're going to see more of the same in terms of higher yields.
Okay, interesting to hear. And I recently spoke to Michael Howe, and I think viewers will sort of hear that interview before this one. And he was saying that sort of what Janet Yellen did with moving bonds, up the sort of duration to bills, actually, reduce the longer sort of yields. Do you buy into that? Do you think that sort of had an impact? Now we're just seeing a normalization.
Yeah, I think that, it's true, to back up, there's this thing called the Treasury Borrowing Advisory Committee. So it is a committee of a bunch of Wall Streeters. And by the way, Beth Hammack, who is now the Cleveland Fed president, used to head it when she was the treasurer at Goldman Sachs for many years. So she's got intimate knowledge on it. And they advise the Treasury on what is the best way to issue trillions of dollars of debt. And I want to emphasize the word advise, right? They don't make the rules. They just say, here's the best way to do it. One of the things that they had advised for many years is that the total amount of Treasury bill issuance shouldn't be more than 20% of all issuance. And what we've seen in the last couple of years with Yellen was higher than 20% bill issuance. So that means that coupon issuance, 10-year, 30-year bonds, we've been issuing relatively less of them because we were issuing relatively more of T-bills. And some people have argued, probably not wrong, that helped to depress longer-term interest rates. I'm talking about over the arc of the last couple of years than they would have been. And it's helped to, keep short rates up and probably helped to keep the yield curve inverted, higher short rates than long rates, longer than it would have been normally. Now, the yield curve has recently, in the last several months, uninverted. So now Scott Bessent is going to, he's this Treasury nominee by Trump, and all indications are he's going to get approved, is talking about going back to that 20% rule, if not a little bit the other way. And that's also got the idea that you could see pressure being put on long-term interest rates because we're going to issue more of them. So when Bessent is asked, well, if you're going to issue more notes and bonds, isn't that going to push up interest rates? What are you going to do to mitigate that? His answer is always the answer. Well, we'll just have a smaller deficit. We'll just borrow less overall. Well, that's great in theory, but I would actually like to see a U.S. government actually have a smaller deficit. It's been many, many years since we've seen one of those things come down, smaller deficit, and the need for borrowing to go down. But that's the way he intends to fix it. But in the short term, we're probably going to see more bill and note and bond issuance, and that is just more supply, lowers the price, raises yields.
Okay, yeah, that's interesting. Do you think Scott Bessent, do you think he is going to be able to or make any changes, or is it just going to be sort of the same? He's going to realize his limitations and just do the same as what Yellen did?
Well, I think he's got a plan to maybe make some changes. His plan famously is called the 3-3-3 plan. It is to get the deficit to 3% of GDP. It's now around 6 or 7% of GDP, which is extraordinarily high. As a matter of fact, for the U.S. government to borrow 6 or 7% of GDP, the only other times they've borrowed that much has either been in a war or a recession. And we are not currently in a hot war or a recession right now, but we have got just such profligate government spending. So plan one is go to 3% of GDP in borrowing, which means to cut spending. Okay, that's great. And I'd love to see that happen. Plan number two is to get GDP growth up to 3%. I'd actually argue we're almost there right now. So that's like one of the three that, he would can almost take victory for before he even assumes office. And plan number three is to increase oil production by 3 million barrels a day. Now, two things about that. One, he's the Treasury Secretary, not the Energy Secretary. So I get the idea that you want to see more oil production. That is fine and dandy, but I don't know how much influence the Treasury Secretary can have over that topic. Trump can, but, and Trump could adopt his policy, but he can't. And second of all, oil's a funky thing too, right? Let's increase by 3 million barrels a day. Engineering wise, the U.S. could do it. I think there is enough excess capacity that the U.S. could put enough wells in to add an extra 3 million barrels a day. Now, over time, it take many years. It won't happen right away. But then you get into the economics, right? If you increase by 3 million barrels a day, doesn't that drive the price down to like $30 or $40? And then a lot of these oil companies, that are trying to increase production, they're not profitable down there. They're losing money. So they just stop producing it and the price goes back up. So how do you increase by 3 million barrels a day and keep the price, say, over 60 so that the oil companies can make a living off of it? And it's not so high that, homeowner or motorists are crying about the price of gasoline. That's a very difficult one. So of the 3% deficit, that's cutting a lot of spending. I'd love to see that. The 3% of GDP, I think he's already got that. The 3 million barrels a day of his 3 program, I just don't know how that's going to work. I know in theory we can add it, but if you add it and you collapse the price, you're just going to bankrupt a lot of oil companies, and then they'll stop producing, and then your 3 million barrels goes away and the price goes back up. So I'm not quite sure how that last part's going to work.
Yeah, especially in shale, a lot of their break evens are sort of mid 50s, and I could maybe see it if of some people saying sort of new Monroe doctrine, the Western Hemisphere, where the US is focusing on. If you included the whole of South America and I guess North America in that 3 million, I could probably see that. Guyana, Brazil, Argentina, they're sort of coming online. But yeah, specifically the US, I think that would be an issue.
Right. And even if you were to do that in a Monroe doctrine kind of thing, and if you get Polivé in as the new PM in Canada, and he's more amenable towards oil sands production up there. Yeah, you could, like I said, engineeringly, you could make the case that there is the ability to increase by 3 million barrels a day, whether it's U.S., Canada, or even if it's down in South America. But what about the price? Like I said, if what you're doing is just swamping the market with excess supply, collapsing the price, then a lot of people are going to go bankrupt. And you're right about shale. Shale is expensive. It's not cheap to do a shale field. You need the price at least at the mid 50s to $60 in order to make it profitable. If you drive the price down to $45 or $50 on an extra 3 million a day, then the shale production is going to stop, and you're going to be caught in this infinite loop. We increase production, price goes down, we decrease production, price goes back up, and we'll just be caught in that cycle, and we'll never get to that permanent 3 million a day.
Yeah, definitely. We'll have to see what they do. And then if we go to, so say if what you say happens, yields, it's going to be a bit of a, I'm sure, bumpy ride, but they sort of slowly, I guess, drift up a little bit more. What impact do you see this happening on the stock market? If we look at sort of 20% sort of return years, it's been pretty good for the average person. High, extremely speculative assets have gone up like Bitcoin, etc. So can you see this continuing, or what do you think?
This is the question right now. And usually when we talk about investing, people at the end of the day like to subscribe to a bunch of theories, sophisticated theories, several theories, what causes markets to go up or down. I like to say, but at the end of the day, they all have a ruler and they just draw straight lines, and they're momentum investors. Why at the beginning of the year was everybody so bullish on the U.S. stock market? Strategists had one of their more aggressive forecasts that we've seen in several years, because the last 2 years, the stock market, the U.S. stock market, had back-to-back 20% years. So what does that mean for 25? Another 20% year. Conversely, the bond market has been struggling for the last couple of years. So what does everybody think it's going to do? It's going to struggle, because that's what it did. Gold was up 25% last year. By the way, last year was the first time ever that gold and the U.S. stock market were both up more than 25% in the same year. And people still think it's going to go up. So what I'm trying to say is everybody's momentum driven. But I think a better metric to use might be valuation. Oh, but can't use valuation as a timing tool. Yes, but it was never, ever designed to be a timing tool. What valuation does is it's a good expectations tool. Bob Shiller, Yale University, won the Nobel Prize in economics for his valuation model, that was based on the CAPE ratio, the cyclically adjusted PE. And the concept is very simple. The higher the valuation in the stock market, the lower the future returns. If you look at his CAPE ratio and you look at earnings yields and you look at real yields and everything else, I'll sum it up for you. We're probably looking at a 5, 6, maybe 6.5, 7% return out of stocks over the next several years. That doesn't mean that we're going to get 5% this year, but it's saying collectively per annum something around, say, 5 or 6%. Well, bond yields are 5%. So as bond yields go up, the stock market seems to struggle. Is it because we're worried that bond yields are high enough that they're going to break something? I don't think that's the case. I think what it's more likely the case is it's competition, that people are starting to realize, you know what, maybe the stock market's juice has been wrung out of it, and it's not a bearish call. It's just a more moderate or temperate call. You're looking at a 5 or 6% world for stocks. Well, if I could get 5% in the bond market with much less volatility, because the bond market in 2024 had a bad year, and it was still up 2% in a bad year. Stock market has a bad year. It's doing a lot worse than being up 2%. So I'll take most of the stock market's gains in the bond market with a lot less volatility. So as rates go up, it provides competition for stocks. What I'm arguing is not new. This was the way that the world worked in the 70s, 80s, and 90s, that bonds were always competition for stocks. That when you looked at bonds and said, well, they yield you a little bit less than stocks, but they have a lot less volatility than a risk-adjusted return, they're kind of the same thing. That's the way it used to be. Then we got into quantitative easing, and from 2008 to 2020, and TINA, there is no alternative. Everybody's got to get out of bonds. That era is over. So as interest rates go up, the stock market gets worried that it's got real competition on its hands, as opposed to that it's going to choke off the economy and crash things. I don't think we're there yet right now. We'd have to go substantially higher in interest rates before we got to that scenario.
Okay, yeah, a lot to unpack there. And I think the researchers, they were sort of bidding last, or the banks predicting where the S&P was. If you look at the predictions, that a lot of them were so far off. So many were saying 5% down, a little bit up because of the last result. 2023. So they're probably sort of, we were burnt last year. Let's just say it's going to keep going up.
And it's also the momentum, right? The market's very strong, and it's momentum. Look, the bank forecast on the S&P, I kind of like it to, the betting odds in a sporting event. And in American football, you could say, well, some team is a 3-point favorite. Well, that's useful to know, whether they're a 10-point favorite or underdog or a 3-point favorite. But that doesn't mean that they're going to win the game by 3 points. They could win the game by whoever knows what it's going to be. So these bank strategists forecasts are useful because it tells you which way everybody's thinking. And not a single one, by some of the surveys I've seen, actually had a lower price for 2025. Now, there are other strategists out there. They just weren't in some of these more commonly surveys. But yet there was this general bullishness in the market. So the point spread's very, very high. And if you wanted me to stick with the sporting metaphor, maybe you want to take the under, or you want to give the points, betting that the team won't cover all of those, won't cover all of that point spread. And in the stock market, it's a big point spread, given what we've seen all of these strategists, predicting with these very high numbers, 6,600. There's one, I think the high one is 7,100 on the S&P for 2025.
Yeah, people think it's going to go up more. And I guess, there's some great companies out there, but as you're saying, that the valuations are just, they're predicting perfection.
Let's not confuse great companies. Let's not confuse what great companies with valuation. I mean, I hear people say this all the time. NVIDIA is a great company. Amazon's a great company. Microsoft is a great company. The Mag 7s are excellent companies, and they've got tremendous products, and they're going to be revolutionary products. I agree. AI is going to be more important than the internet itself. The problem is all the profits you're going to get off of investing in those companies is already in the price. So you have to give me that story and say, and here's more that we're going to do than what is the consensus. And that's what the problem is with valuation. It's not good enough to just say it's a good product that people want, and it's a good, people are going to buy it. That's in the price. I need more than that. And that's when it becomes very difficult. And if you want an example, go back and look at the NASDAQ in 2000. In 2000, everybody bid the NASDAQ to the moon, to the 5,000 is where the NASDAQ got in 2000. And they said, this internet thing is going to be transformational. And they were right. It was. The problem was you'd already built into the price that transformational outcome. So when the NASDAQ peaked at 5,000 in the year 2000, it took 12 or 13 years for it to eventually recover and make a new high. So, and what did the internet stop in those 12 years? No, it fulfilled all of the promises that everybody told me in 2000, but you'd already put that in the price. So what happened was every promise you told me about the internet happened and you lost money because it was all priced in 99 and early 2000. And that's what I fear is happening with AI. Every promise you say AI is going to do, self-driving cars and everything else, it's all going to happen. And it's all going to be as important as it is. But you've already got it in the price. And your reward will be, while all that's happening, is maybe those prices don't do anything for several years. That's the risk you have when you buy highly valued companies.
Yeah, great point. And it does seem, we're talking about potentially extremely strong economy. Well, it definitely is, strongest economy, high yields. It's going to be a sucking. You imagine that everyone's going to keep investing in the US, no matter how they do it. So it does seem like it's sort of pretty bleak for the rest of the world.
Right. Everybody will keep turning to the US, but let me give you another statistic. And this comes from my friend David Rosenberg of Rosenberg Research. 80% of equities are owned by somebody this is US equities, are owned by somebody over the age of 55. 80%. Over 30% of the US equity market is owned by somebody over the age of 70. Now, all old people own stocks, and by the way, those numbers in the last 20 or 30 years are up substantially from where they were, because it was under 60% over 55, say 20 years earlier, and now it's 80%. So 50% increase in that number. So what does that mean, that older people own all the equities? Well, one, it's not so shocking that they do, because older people have the money. And that's always going to be the case. So the millennials and the Gen Zers, in 40 years, you'll be the old ones too, and you'll have all the money. And that's kind of the way that the cycle works. But I always argued that a bear market in equities is time, not price. People say, well, the market went down and it's getting crushed, but don't worry, it always comes back. It always does. Dollar cost average all the way in. Great. If you're 35 years old or under, absolutely. Maybe you'd even want a bear market. Yeah, let's knock the prices down 30 or 40% so I get another chance to buy them in cheaper. And then maybe it chops around for several years after it gets off its peak before the next bull market. You could dollar cost average in when you're younger. But what if you're 68 years old and you're told that your net worth in retirement is hitting its peak right now, and the market's going to go down, it's going to chop around. It might take 10 or 12 years, like from 2000 to 2013, before it eventually makes new highs, but it'll make new highs. You're going to still go, but I'm 68. I'll be 82 by the time I get back to the net worth that I am today. I mean, I'd like to tell you I'm going to live to 137, but I'm probably not. So then you turn and you say, well, what other options do I have? The bond market is giving me most of what the expected returns are in stocks with less volatility. And we've seen a bit of a right turn if people putting money in the bonds. And then the people say, why are they doing that in bonds when stocks have so much upside? Because they're 70 years old and they see that there's a lot of rich valuations in the stock market. And they don't have a 40-year life expectancy. So if we're going to go down and have a decade of depressed prices so that they could just keep buying and buying, and they don't even work anymore, so they're not even they're in retirement, so they're not even producing an income to continue to buy to dollar cost average. So they're looking around, they're going, give me some of the bond market. I'll take most of that. A bad year in bonds is up 2%, as opposed to what stocks could be. So while everybody's going to be flying in the US stocks, the vast majority of them are owned by old people. They're going to say, you know what, maybe I'll just go hang out in the bond market because it won't burn me and it'll give me most of what the stock market has and I can sleep at night.
Yeah, and if you get the internationals leaving as well, then that's, taking their money back to Europe, to Japan, to wherever else, and that's going to be another issue.
At some point, if you look at the value, as I said, the valuations in the U.S. market is very, very high, meaning that the expected future returns is somewhat moderate. If you look at the valuations in the European market, especially the German market, it's very low, and the expected returns are up there quite a bit. Well, the problem is, maybe what you should be doing is dollar cost averaging into Europe, betting that there will eventually be a rebound in Europe. But we're all momentum players. We don't think that way. We're all going to chase, we're going to all chase the stocks that are up 1,000,000% because we think they're going to go up another 1,000,000%. But you're right. At some point, if you do then eventually get to a rebound state in the economy, old people in the U.S. will say, you know what, give me some of the bond market. Europeans and some other international investors go, you know what, maybe we should be investing in Europe. It's cheap. It's been beaten up. And now their economy is starting to recover. There's a lot more potential there than buying extremely overpriced stocks in the U.S., betting that they're going to go even more overpriced.
Yeah, it could be on the horizon. Let's be honest, most of those companies, most of their sales from the US anyway. So they're not, they're not really pure. A lot of them aren't pure European plays. But
40 odd percent of the not every S&P company reports a geographic revenue breakdown, but those that do, and it's like almost half the companies, it's like 40% of their revenues come from overseas. So there is definitely a lot of that going on as well too. So but if you're going to play a European rebound, play it with European stocks. That makes a lot more sense than to buy a bunch of US companies that are much higher valuation that sell a lot of stuff in Europe.
Yeah, it's a great point. So, Jim, thanks so much for your time today. We've sort of gone all over the globe, touched on so many different things. But my last question is, what is one message you want people to take away from our conversation?
So the message I would give you is be careful with investing in momentum plays. The things that are up a lot, betting that they're going to be up a lot. The things that have been down a lot, expecting that they will continue to be down. Look at valuations, because valuations could be a signal that the tide is changing, and that's very important when you're trying to invest. Otherwise, you wind up, with momentum investing, and momentum investing works great until it doesn't. Like the old meme from the movie Top Gun, right? Maverick, that was some of the best flying I've ever seen, or momentum investing, right up until the moment you were killed. That's what you have to be careful with momentum investing. Man, it works great. You make a lot of money, and then you slam into the canyon wall at 1,200 miles an hour, and you're all done with. So be careful when it comes to chasing momentum, and do put valuation on your radar screen.
Yep, great message. So thanks again. So if anyone wanted to find out more about your work and what you do, where would the best places for that be?
2 places. Bianco Research is my research business, biancoresearch.com, at Bianco Research on Twitter X, at Bianco Research on YouTube. My name, Jim Bianco, on LinkedIn, whatever your favorite is. Number 2, we do manage an index, and there's an ETF that tracks it that you can find out more about. It's a fixed income total return index. So it's primarily a fixed income fund. It's at Bianco Advisors. You can find out more about it. And the ticker symbol for the ETF that tracks our index is WTBN. Wisdom Tree is our partner. So it's Wisdom Tree Bianco Nancy is its ticker symbol.
Perfect. I'll put that in the description below, but thanks again for your time.
Thank you.
Hey, everyone. Thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that, but it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching, and see you on the next show. And you also might like this video right here. All right. Thanks again.